Hello, everyone. Welcome to the June episode of First Look ETF. I'm Stephanie Stanton with ETF Guide. It is great to have you with us as always. Coming up on today's program, we'll tell you about a new pair of ETFs designed to provide downside protection for stock market investors. And we'll explore a new thematic ETF focused on the artificial intelligence boom. Plus, a look at a recently launched ETF with a unique growth approach to investing in foreign stocks. But first, to kick things off, we've got Douglas Yones, head of ETFs from the NYSE. Douglas, it's always great to see you.
Hi, Stephanie. It's great to be back.
Let's talk about the latest update on the ETF launch activity. What are we looking like?
May was a super busy month here at the New York Stock Exchange across the whole industry. 58 ETFs launched in May, raising over $2 billion in brand new assets for the ETF industry. That takes us to over 3,500 ETFs now in the US with over $9 trillion with a T in assets under management. And guess what? And you'll hear about it in today's show. 2 more mutual fund to ETF conversions in the past month. So that trend continues.
Yeah, it really is exciting. We've now reached the halfway point of 2024. The ETF market has already achieved many important milestones, as you shared. Is there anything specific, though, that you want to focus on that's really jumping out at you?
Yeah, here we are in June. It's the midway mark. 239 ETFs have launched this year, raising $71 billion in assets under management. And guess what? 70% of those have all been actively managed. Other trends, about a third of all cash flow this year is going into active ETFs. And guess what? No shock. Those ETFs continue to do what they say they're going to do. And investors are looking for them. The demand is there. Also, the other trend, we've talked about it on the show, the mutual fund conversions, 7 conversions this year, converting over $1 billion in new cash flow across the ETF industry.
Yeah, it really is incredible. Also on today's show, we're going to be diving into an ETF that focuses on AI, which of course is a huge trend. When we talk about some of the trends, what other trends are you monitoring? Maybe look into your crystal ball. What are we going to see throughout maybe the rest of the year?
Yeah, let's pull a few out. The research team at ETF Central, they're always on top of this. They're always looking. First and foremost, a third of all cash flow this year, fixed income ETFs. Why? Income, no surprise, continues to generate a lot of headlines. It's what people are looking for. Today's show is going to talk about income. Other key themes, risk control, risk mitigation. Guess what? Today's show, we're going to talk about that brand new, never done before risk mitigated ETFs. Matt Kaufman from Calamos is going to be here to talk about those. And as you mentioned, AI, all over the headlines. As you mentioned in the show today, we've got the team at TCW. So across all 3 guests, you're going to hear a lot about income from Pacer, you're going to hear from risk mitigation, and you're going to hear about AI. As a reminder for everyone, you can catch all of our latest webinars, our podcasts, and you can do all the research you want at our website, etfcentral.com, brought to you by the New York Stock Exchange.
Gotta love it. We are always on top of the trends. Thank you so much, Douglas. It's great to have you. We'll see you soon. And just a quick reminder to watch First Look ETF on Apple TV, Amazon Fire TV, and Roku. Also, we simulcast First Look ETF on iTunes, Spotify, Amazon Music, and other major podcasting platforms. So be sure to check us out there. A recent study conducted by PwC estimates that artificial intelligence, also known as AI, could contribute up to $15.7 trillion to the global economy by the year 2030. That is more than the current output of China and India combined. Well, joining us to share more about their recently launched ETF targeting investment opportunities in AI is Bo Fifer, Managing Director and Lead Portfolio Manager of the TCW Artificial Intelligence ETF. Hi, Bo. It's great to have you with us.
Hi, thanks for having me. It's great to be here and appreciate the opportunity to talk with you and your audience about AI.
Yeah, absolutely. Before we dive into the specific ETF, which the ticker is AIFD, bring us up to speed. How is artificial intelligence changing the way that business gets done? And why do you think it offers an attractive investment opportunity?
Yeah, we do think it's changing or will change every industry in profound ways. But we are very early in the build out of the infrastructure required to support these services. So we compared the current wave of AI to prior mega cycles in technology or other technology waves like PCs and internet and cloud, smartphones. And what we found is that about a year and a half into this AI wave, the leaders are tracking very much in line with the performance that the leaders of prior cycles put in at this point in the cycle. So if you go back to smartphones, that was roughly a 15-year cycle. PCs was roughly a 20-year cycle of growth. And cloud is well into its 10th year of growth at this point. After the first couple of years, where performance, certainly for AI stocks over the last year and a half, have been quite positive, these trends then proceed for another 5 to 10 years or longer, and the returns are even bigger. So we think it's very early, and the investment opportunity is so attractive because this is a decade-long trend, if not longer, and we're so early in it.
So the TCW Artificial Intelligence ETF, again, your ticker is AIFD, was actually recently converted from a mutual fund structure to an ETF. Tell us more about the fund's investment strategy and holdings.
Right. So we did convert from mutual fund to ETF about a month ago. And I think investors benefit in a number of ways from that, from increased transparency to better liquidity and intraday pricing. It doesn't change the way we manage the fund. It's an actively managed, conviction-weighted, concentrated portfolio that typically invests in the stocks of 30 to 50 companies that we consider to be leaders in the development and commercialization of artificial intelligence. We like to say we're not trying to buy all AI companies. We're just trying to buy the best AI companies. And we put those opportunities into three buckets. The first we call core technology, and that is the infrastructure and hardware on which AI systems are built. It's the servers and switches and chips that go into data centers. The second bucket we call AI systems, and this is usually software companies. It's the AI systems themselves, the models and the platforms on which they're run. The third bucket we call AI adopters. And these are companies that are using artificial intelligence to gain a competitive advantage or widen their competitive moat, increase their revenue growth rate, expand margins or reduce costs, and therefore grow earnings or cash flow at a rate above their peers. That's where we think the portfolio is headed as AI proliferates into other areas of the economy. Today, we are very much positioned to capture that initial build out of the AI data centers and systems. But over time, we'll see more of those, what we call AI adopters in the portfolio. I think in the next round of technology IPOs, we'll see a lot of AI systems companies. So the portfolio will migrate with the technology over time. There's an important concept that we use in the management of the portfolio that we call meaningful and measurable. The impact of AI on a company's fundamentals has to be meaningful and measurable. Meaningful in the sense that it's significant enough to move the needle, and measurable in the sense that it's something that the market can see and track. Because if you can't see it and track it, then it's not going to move the stock. And I'll just point out that we do have a 7-year track record, even though we converted this fund to an ETF a month ago. The predecessor mutual fund was launched in 2017. So we've been investing in AI since long before the generative AI craze.
Yeah, that's good to know. So before we let you go, what type of investor would a fund like AIFD potentially appeal to?
Well, really, I think it's first and foremost anyone who believes in the long-term potential of AI. We view it as complementary to a core portfolio with the ability to capture alpha as the economy embraces AI tools and services. I think being actively managed is very important here. Technology changes so quickly. You know, we're like I said, a year and a half into the generative AI trend, and already the technology looks completely different than when it was launched in late 2022. So being able to position the portfolio in front of key inflection points in the development of the technology, I think is really important. And yes, we do own the mega caps and the Magnificent Seven, but we get a lot of alpha from some of the more obscure names and predictive AI names that right now are not getting a lot of attention.
Makes a lot of sense. It is a rapidly changing world when it comes to AI. Bo Fifer, thank you so much for joining us. It's great to have you.
Thank you very much.
Structured protection ETFs offer a unique way to participate in stock market growth while providing a downside shield. Now, this fresh approach gives investors new ways to combat market risk and volatility. Well, here to discuss two new funds in this fast evolving ETF category is Matt Kaufman, SVP, Head of ETFs with Calamos Investments. Hi, Matt. It's good to see you. Thanks for joining us.
Thanks, Stephanie. Thanks for having me.
Okay, so studies on the psychology of investors have actually shown that the pain of losing is psychologically twice as powerful as the pleasure of gaining or winning, which I didn't realize that, but I guess it makes sense. To avert losses, some investors, they are now taking a very defensive approach. So in your opinion, what is driving the trend toward 100% capital protection strategies versus capital at-risk strategies? Have people just grown more risk averse?
Yeah, I think you're right. There's a behavioral aspect to having no downside risk in the market, but then having the upside potential relative to a broad index. There's also mathematical impacts of that as well. For folks who have maybe a less of a time horizon toward retirement, people entering retirement, we're seeing a massive swath of retirees entering that phase of life today. It's the largest in U.S. history. And so, not only from a behavioral perspective, but also, from a mathematical perspective, those financial risks that are facing retirees, like longevity risk, inflation risk, volatility, these types of products can really solve for all three of those problems.
Yeah, I guess that makes sense when you talk about the sheer number of people headed into retirement. Calamos recently introduced a pair of structured protection ETFs, those tickers, CPSM and CPNJ, which, by the way, are not to be confused with buffered strategies. So explain how they are different and then how they work.
Oh, that's a good point. Yeah, a buffer strategy is a fast-growing part of the ETF landscape. Similarly constructed, but a buffer provides partial principal protection. Here, the rate environment has come off of zero, and at Calamos we have developed this whole series of ETFs. So we've launched 2. We're also on file for 12 ETFs, so one every month that's going to deliver 100% protection, and then the upside to a cap. There's no free lunch in the market, so you have a capped upside. But for our CPNJ, our NASDAQ series, for example, has an upside cap of 10.2% and then 100% protection over a 1-year outcome period. So there's going to be 12 products in total in the market. CPNJ just launched June 3rd, and then we're on file for a Russell series in July.
Wow. Yeah, that 100% protection has got to sound very attractive to investors. So how can investors and financial advisors potentially use ETFs like CPSM and CPNJ inside of their diversified portfolio?
Yeah, we're seeing two sides of a coin here. So the first would be de-risking equity exposure. The NASDAQ and even the S&P are near all-time highs. And so we're seeing advisors de-risking their equity exposure by moving money into the structured protection ETFs. And it allows them to really choose how much risk management they want. If you want to say take 50% of your equity risk off the table, you can move half your equities into CPNJ, but then you preserve that upside potential from 0 to 10.2%. Your portfolio still captures all of that upside. And then because you've moved, maybe half of your equities, you're not capped out, but you're capturing 50% of that upside move beyond that. So we're seeing people de-risk equity exposure. And then I would say the other side of that coin is the ability to link your cash to the equity markets. A lot of money has moved into CDs, money markets, fixed index annuities, which provide 100% protection. And so people can move into this tax efficient wrapper that gives them the upside opportunity, again, to around 10%. And you can link your cash to the equity market in a way that grows tax deferred. And then if you go to sell, if you've held for longer than 1 year, it's long-term capital gains. And so we're seeing a lot of people use it that way too.
Yeah, it's interesting you say that, because I was thinking, is it hard to sort of lure people back into ETFs and other, financial instruments when they can just keep their money in a bank and earn, 5-6% comfortably?
I think that's one way to do it. If you consider inflation, it becomes difficult. Even a 5% interest rate, when accounting for inflation, does not give you that opportunity to actually outpace inflation. And so we see a lot of folks, especially retirees, like I said, who are tying their money to the equity market with no downside risk over that outcome period, and it allows them to outpace inflation over time and outpace their spending, which is good.
Yeah, makes a lot of sense. Okay, Matt, thank you so much for joining us. It's a pleasure having you today.
Thanks.
Some investors suffer from home country bias, which means that they are concentrated in domestic stocks, leaving their investment portfolio with minimal exposure to foreign equities. Well, the recently launched Pacer Developed Markets Cash Cows Growth Leaders ETF is one potential solution for filling in the missing gaps. And here to elaborate is Sean O'Hara, President, Pacer ETFs Distributors. Hi, Sean. It's good to see you.
Hi, Stephanie. Nice to be with you.
So before we discuss the Pacer Developed Markets Cash Cows Growth Leaders ETF, and again, that ticker is EAFG, why should investors consider owning international stocks from developed markets?
Well, international is always going to be a part of a well-diversified portfolio. You get access to different countries and industries in those countries, and really you get access to the currency as well. Some people worry about currency risk, but to have all of your assets in the United States means you're very, very narrow with your exposure. So as a part of a well-diversified portfolio, international has typically been 15 to 20% of those portfolio weights over time. More recently, it probably has shrunk a little bit, mostly driven by how much better the performance has been here in the U.S. and particularly large cap U.S. stocks. But over time, things tend to equalize themselves. And so I think we should be thinking today a little bit about rebalancing our portfolios to a more traditional allocation to non-U.S. stocks.
So what does EAFG's geographic and industry sector exposure look like?
Well, let me just start with the premise, if I can, because it's really important in this case. So we launched a series of value-based ETFs at Pacer called the Cash Cows using free cash flow yield. We recently took on the job, if you will, or the project of trying to figure out how we could then sort of redefine growth like we redefine value. And we think that the metric we use here, which is free cash flow margin, which is the free cash flow a company generates divided by its enterprise value, is a better way to access high quality companies that are growing, but that are turning those sales that they make into profitable sales by that ratio. And so when you use that metric, you're not going to own the whole broad-based index. Like we source from the EFA index, but we only pull out 100 stocks with the highest free cash flow margin. So you wind up getting foreign stocks that grow their earnings faster, for example, and that grow their sales faster than the traditional broad-based indexes. And so for those people who are a little bit frustrated with international from a performance perspective, our goal here is to not own the whole ex-US swath of stocks, but focus on those stocks that come out of the EFA index with that higher free cash flow margin. And so you look at country exposure, Japan is a big holding, UK is a big holding, and I think the third largest country in our portfolio would be Switzerland today.
Okay, and then some of the industry sectors.
Well, I think you're going to see, because if you use that free cash flow margin screen, you're going to see some technology in there for sure. You're going to see some energy in the portfolio. You're going to see some, broad-based large consumer names in the portfolio. So it's not necessarily a sector story for us. It's really an individual stock story for us. We want to own the 100 stocks that we can pull out of EFA that have the highest free cash flow margin, because we think that's a very, very healthy metric for growth. And so the work we've done in sort of looking at this over time is similar to the work we did when we launched that alternative or different way of looking at value. So we're excited about the whole suite of products in this Cash Cows Growth series, EAFG being one of the latest.
Got it. Okay, what type of investor then might EAFG potentially appeal to?
I think it's pretty, obvious to me when you have a portfolio that's allocating a certain portion of your money towards international stocks. Don't just buy the whole index. You're buying a whole bunch of things that you don't really know much about. If you're selective about what you buy and you want to buy high quality companies that grow their sales and their net free cash flow faster than the rest of the pack, if you will, then that would be the ideal investor, to just simply take a portion of their international exposure and replace it with this and be more selective about the types of names and the quality of the names that they own.
All right, Sean O'Hara.
Thanks so much for having us. We really appreciate it.
And that does it for today's episode of First Look ETF. Now, if you enjoyed the show, tell us in the comments section below and by hitting the like button. We want to give a big thanks to all of our guests, along with Douglas Yones at the New York Stock Exchange. Be sure to check out etfcentral.com to learn more. I'm Stephanie Stanton with ETF Guide. Thank you so much for watching. We'll see you next time.